All right, we're live. We're live. Good morning, everybody. There we go. Okay, cool. Now we're live. Hello and welcome to the Premarket Rundown for what is this Wednesday, March 22nd, 2023. This being our daily session where we go over all the news and notes pre-market that are going to be absolutely paramount to keeping you consistently profitable here across these crazy volatile times, volatile happenings. As always, I'm your host, Adam Allen, stock options expert market strategist, and we're here to dive into the important things of the day. If we can get this camera to focus on in, there we go. Awesome, awesome. Maybe I need to scoot over a little bit as well. There we go. Okay, that works. As you guys can see, not in the normal spot. We got the conference this week, but I am working it out as always. You gotta push through, figure out a way to make it happen. So I had to jump through some hoops here to be here this morning, but happy to do so. Got the webcam up and working and wanted to give me issues earlier, but as of right now, looking good. Huge day today. Huge day. Possibly the biggest Fed day we've had in the past few years. As you have, Jerome Powell stuck between a rock and the hardest of places. So like I said, I do not envy him at all. But this is a day that we've been waiting for pretty much all week because today is really going to cement. Um, it's going to cement how we move, moving forward, and we're in a very pivotal spot, in terms of kind of price action wise, market wise, in terms of whether or not we continue to go down or we can break that cycle and push up. All that really rides on what we get today. We have a lot of tech that's been trying to push, that's been attempting to push. Speaking of tech, attempting to push, this camera went up. Okay, there we go. Push to clarity. We've had a lot of tech trying to push, trying to break out on the weekly. And a lot of that will boil down to what we end up getting this week, right? Really what we end up getting today. And if Powell kind of maintains the daily downtrend or if he breaks the daily downtrend. So let me see here. I guess we have everything up and ready to go. I just want to double check and make sure. I guess I'll go and post to Instagram here. Make sure everybody can find us. Again, we're on sometime between 8:40 and 8:45. So just make sure you're here around that time and you can catch, what we have going on in markets today. So I'm just going to post this on my Instagram story. Make sure everybody knows where we're at, what we're doing. All right, live now for the biggest Fed day of the year. Let's see, we'll throw an emoji on there. Okay. All right. Yeah, if you guys are just popping in, you know the drill, what I'm doing right now. Throwing this on the Instagram story. Had to make myself a quick breakfast. Okay. Let me go get the link for this. Hopefully you guys are catching on to the kind of workflow here when it comes to the lives. If you come to my just page on YouTube, you'll see that I'm live and you can just go from there. But just in case, boom. Now we got the link up. Everybody knows where to find me, and we can dive in uninhibitedly. Anybody who misses, right, can go back and watch the recording. But we're kicking off, of course, with our top headline, our most important headline here, which is Fedilemma. So, leading up to the Federal Reserve's March 21st through 22nd policy meeting, traders have been expecting the FOMC to ratchet up its key interest rate by 50 basis points because the economy appeared to be surprisingly robust. But then 3 U.S. banks failed: Silvergate Capital, Silicon Valley Bank, and Signature Bank. And a fourth is teetering, which is First Republic Bank. That may have Fed policymakers rethinking their expectation for a rate hike today and their upcoming rate path. While the whole episode came during the Fed's blackout period, creating even more uncertainty about what may lie ahead. So I think that's what makes this meeting even more important, is because this is the first insight that we've gotten from the Fed at all, right? They have a blackout period before they go into meetings where they can't speak to media. So we haven't been able to hear from any members of the Fed on how this impacts, their mindset, their analysis of markets, their game plan, in terms of the economy, right? We have no idea. So this is the first bit of information that we get from literally the apex of our financial system right here in the US with the Federal Reserve, our central bank. This is the first insight we get from our central bank since we've seen multiple banks collapsing, and really just we're on really on the brink of financial turmoil, with not really a whole lot of options and not a whole lot of faith, and the remedies that have been happening. Right, we have them coming out saying that they're looking to raise the FDIC insurance so that all basically all depositors are covered, and it would be like 16 trillion, and they just have nowhere near that in terms of how much capital that they could actually use to backstop depositors. So at this point, it's all kind of an elaborate facade to just try and keep people from being scared. I'm not trying to incite fear, but it is what it is. It's like if you're at the gym and you're benching 300 pounds and you ask the skinniest dude at the gym to spot you, they can tell you all they want. Like, look, I got you, I got you, I got. But I'm literally looking at you. I'm looking at your scrawny little pole arms, and I see that there's no way if I don't lift this weight back up, you can lift it back up, right? So that's exactly where we are right now, kind of, with things going on and all these people looking to get their deposits insured and everything covered and all that. It's not realistic. So we'll see what Jerome Powell looks to do. But overall, this is probably the toughest decision he's ever had to make before in his life. Like, bar none. I mean, if he decides to not hike, then you just have inflation that gets right back on the path to shooting back up, right? All the factors that were pushing inflation higher are still in effect, right? The war in Ukraine, especially, those things are still in effect. In order to kind of decrease inflation, he has to keep the pedal to the metal, right? He has to keep slamming on the brakes. If he lets up off the brakes, he'll just speed right back up again. I think people forget inflation is at 3 times what it's supposed to be, right? 3 times the target rate. It was just at almost 5 times earlier. But that's like if you're going 100 miles an hour and you speed down, now you're going 70 miles an hour. You're still going over the speed limit, of 30. So either way, you're screwed, right? So, and the big thing is kind of like if he pauses hikes, or now they're expected to do a 25 basis point hike. 25 basis point hike would be within expectations. If they pause hikes, boom, market like gonna fly. But if they, do pause hikes, and they say, hey, we're going to, kind of pause hikes and make things easier on banks and all that, then it's going to be bad for us in the long term, right? And when I say long term, I'm talking like medium to long term, not like 5 years from now. I'm talking about like inflation 5 months from now is going to be crazy. So he's darned if you do, darned if you don't. So I'm anxious to see kind of how he handles this situation. In terms of backdrop, as a reminder, the Fed has increased its key interest rate for 8 straight meetings, bringing the federal funds rate target range to 4.5% to 4.75%, from 0 to 0.25% in the past year. So he raised from literally interest rates being nothing to interest rates being, almost 5 times that. Um, Meanwhile, the core PCE price index, the central bank's preferred inflation gauge, showed a jump of 4.7% year over year in February, up from 4.6% in January, but easing from 5.2% in March of 2022. Don't forget the efforts to shrink the bank's balance sheet were upended last week as financial institutions borrowed a whopping 153 billion from the Fed's discount window and 12 billion from the newly created bank term funding program. Though assets from emergency lending tend to fall as soon as a crisis subsides compared to holdings added under quantitative easing. So it's not the same, technically as QE. I saw people on Twitter arguing about this. At the end of the day, it's a way for the Fed to inject liquidity into markets, right? You don't necessarily have, it might not be QE, but it's like, I don't know. I don't know what to compare it to. It's kind of like semantics. It's like if you murder somebody, like, is it first degree murder? Is it second degree murder? Is it third degree murder? Somebody's dead and you caused, you were a driving factor of that, right? At the end of the day, the degree of it is up to debate, but like someone got murdered and someone did the murdering. So that's really where we're at when we talk about, QE versus not QE. At the end of the day, it's, the Fed is injecting liquidity. Um, and it's increasing its balance sheet, right? It's not shrinking its balance sheet like it's been trying to do. So, with regards to whether to hike or not, the decision won't be easy. Inflation still remains very high, and a pause now could signal there are deeper problems within the banking system. On the other hand, there are fears that the Fed is moving too far too fast with its aggressive rate increases, and some see the current banking crisis as a direct result of tighter monetary policy. Ultimately, things will boil down to whether the financial stability problem has been limited to a handful of regional banks that has been successfully contained, or if it's something systematic, or if something systematic has broken, with the possibility of the crisis morphing into something larger. I think that's the biggest thing, right? Everybody right now is looking to get some type of information, some type of, exposition, some type of like filler to let us know, okay, is this an isolated issue or is this a systemic issue, right? Are these banks, the ones that already struggled, are they the only ones, or are there more banks right now that are insolvent that just aren't telling us? And that's what a lot of people, have been broadcasting, is that there's a lot more of these institutions, these platforms, these banks that are insolvent, then they're letting us know, right? Then they're indicating. Again, it will be a difference. I feel like if it was the big banks that were struggling, it's not the big banks that are struggling. These are small banks that unfortunately were given too much leeway and did not know what to do with it. And then they were given too much rope and they hung themselves with it. And that's where we're at. With these smaller regional banks, they're going out and touching things they shouldn't be touching and investing in things they shouldn't be investing in, and just being completely ridiculous with things. And they hung themselves with the rope, that was given to them by the last administration, right? When you look at kind of what, and it's not to say that Trump is directly to blame, but if you haven't seen that reel, go check that out over on Instagram. It was regulation that was rolled back under the Trump administration that gave banks the leeway to do this crazy type of stuff, right? That ends up causing these collapses. Before, they didn't have as much ability to hang themselves because they didn't have as much rope. But when you give people rope, right, and they don't know how to act, they're going to act crazy. And that's really what has resulted. So, we'll see, right? If they decide to not hike, I feel like right now it's priced in is 25 basis points instead of 50. That seems reasonable because it might cause fear if he's like, hey, we're not hiking at all. Again, that this is a systemic risk. So if he hikes by 25 basis points, he's like, okay, I'm still increasing interest rates. It's not by that much. I'm showing strength, right, and solidarity in my mission, and also kind of downplaying the severity of what is going on here. If he pauses hikes altogether, then that is kind of giving credence to the fact that this is a big issue, right? If he continues to hike and he says, hey, listen, guys, it really isn't that much of an issue. Like, it is what it is. Like, we're going to keep it pushing. We have more important stuff to be worried about. If he does do that and he saves face kind of publicly, then might be able to avoid panic, but just a tough spot. We can sit here and kind of like theorize all different ways how this could go. It could go so many different ways. The only thing that we really can control is how we react to it and where we are, at the end of the day, right? As I said earlier, we are testing the daily downtrend, the most recent daily downtrend here today, right? So if we close over that level, we can go higher, right? For my people that are in the Facebook group, you get that info, right? You get that level for my stock options made easy graduates. But, if we close over that level, we can push higher. If we hit that level and reject, we continue to go lower. So it's important to recognize that as always, we're in a very pivotal spot as we move into this Fed meeting because we're testing, or at least we're close to testing that downtrend. And we'll see if Powell ends up being the downtrend continuer or the downtrend breaker. I know continuer isn't a word, but agent of continuity for the downtrend, which he has been in the past, right? We'll see kind of what ends up going down. Oftentimes with Fed days, you kind of want to forsake the first move, right? Forsake the first move, look past the first move, and then take that contra move because that ends up being the real one. Oftentimes we will, drop for a bit and then we'll pop, right? So a lot of people kind of have the fade the first move mentality, and that's a good thing to keep in mind, right? Typically, what we get initially from the Fed and from Powell isn't the ultimate move that we get by end of day. So I just encourage you to keep that in mind, right? If you take puts, let's say, because we start dropping, make sure to recognize that we can bounce and we can bounce hard and head in the other direction. So you might, some people say, hey, I just wait, for the initial move to happen. Then once it looks like we're starting to turn around, I get in and I bet on the other side. That's something that works. It's worked sometimes. It doesn't work all the time, but it's worked sometimes. It's really just it's all increased risk, right? It's increased risk, but that is a solid strategy because overall, if you don't want to look to leverage both moves that happen, wait for the first move to happen, and then kind of get in contra to that. So if we start dropping, you wait for a little bit of drop and then get in some calls, see what happens. See, especially if we approach like an important support level, see what happens. If we start to run, right, maybe fade the run, which is hard to do because people love, the green and then they hop in, but fade the run, see, hey, are we starting to top out? And then once we start to top out, you could look to get into puts, especially since we've got that daily downtrend, right? If we go and we rock it a little bit, we peak above that daily downtrend, and then up, we start to fall, we go back beneath it. At that point, then it's like, okay, this was all just a fake out, right? I need to fade that first move, and continue to go with the trend because they'll test you, they'll test your metal for sure. But we'll see what we end up getting today, right? As always, you want to play light, recognize that it is high risk. Everything that's going on right now in this market is high risk, bar none, right? Because we can get information at any point that is very, very volatile, right? That completely turns markets on its head. So we're still not in that spot yet where it's like, okay, things are normal and you can go about trading as normal. Nope, you still want to keep yourself light, right? But overall, we'll look to see if Powell maintains the trend today or if he breaks the trend today. Now, in terms of, let's see here, trying to see, there was a little extra kind of blurb here on the end. I just want to see if it's important. As always, set your voice assistant to that, I guess, alert at 1:50 p.m. Right, tell them, hey, remind me at 1:50 p.m. that Fed minutes are released at 2. Remind me at 2:20 that Jerome Powell's on at 2:30. Otherwise, you can forget and completely get a wrench thrown right into your plans. So let's see here. Moving on to our next segment, deposit runs. U.S. officials are prepared to take more actions if needed to ensure liquidity in the banking sector. Treasury Secretary Janet Yellen said yesterday during an American Bankers Association meeting in Washington, D.C. She defended federal. Sorry, I need some caffeine this morning. She defended federal regulators' actions to protect the depositors of Silicon Valley Bank and Signature Bank, saying our intervention was necessary to protect the broader U.S. banking system. While conditions have improved with institutions suffer with aggregate outflows stabilizing, similar actions could be warranted if smaller institutions suffer deposit runs that pose risk of contagion. So, as of right now, that gives us some insight, right? Conditions have improved a little bit with overall outflows stabilizing. So people are no longer, you guys remember, just last week, there were people standing in lines wrapped around the block at all these regional banks, like pulling their money out and going to put it in Bank of America, Chase, JP Morgan, right? They were going to put all their money into larger banks. It looks like that we've seen some improvement there with outflows overall stabilizing. So people not indulging in bank runs, but they do say here that similar actions might be necessary, right? If these smaller institutions do suffer these bank runs, because that's what causes the contagion. Again, fear is really what kind of materializes the negative outcome. It isn't actually the negative outcome that materializes it; it's the fear of a crazy negative outcome that ends up materializing that. So in terms of our next headline, Meet Bard. So Google has released its artificial intelligence chatbot to the public for use as a response to the growing threat from rival projects at Microsoft and OpenAI. The Bard chatbot will be available to a limited number of users on a wait list picked from those in the US and the UK before Google offers it in more countries. The company is also learning from missteps of OpenAI's ChatGPT and its own demonstration of Bard by limiting the amount of interaction that can occur between Bard and users. Yeah, probably smart because they face planted the first time they unveiled Bard, and Google had its worst 2-day sell-off since 2008. So yeah, they'll probably go about stepping lightly this time. Let's see. Calling the situation a code red in February, Google AI chief Jeff Dean said the tech giant was moving more conservatively than a small startup since it has much more reputational risk in providing erroneous information. Yeah, they're in a tough spot. I mean, Microsoft just did itself. I mean, might have made the investment of the decade when they decided to pour that money into OpenAI, because ChatGPT is absolutely unrivaled in its capabilities. And it will, I mean, Microsoft has been lagging in some things for so long, like Bing. Like Bing integrated with ChatGPT is like head over heels better than Google. And I haven't even tried it yet, right? I don't even know how to go and try it, but I've used ChatGPT plenty. And if those capabilities were, put into a normal search engine, like normal run of the mill search engine, Bing has sucked for so long. That was like, it was like a Space Jam moment where like something that was nothing just absorbed all the talent of the best possible player in the game, right? And that's really what went on with Bing. So Bing could definitely be a powerhouse and completely depose Google if Google does not do something quickly. So I'm not envious of Google. Microsoft, great work. And, OpenAI right now is just on a crazy, amazing tear where it's changing the world. And I can't wait to talk about it more this weekend at Wealthy Revolution Live. Let's see here. Earnings swoosh. So shares of Nike jumped 4% in after hours trading on Tuesday after topping earnings expectations and touting inventory management actions. However, the gains didn't hold and the stock even ended the session down 2%. There you go, guys. Again, volatile markets. You don't know what you're going to get. So don't be out here just gambling. Oh, this thing went up on earnings. It's going to still go up. Like nothing is guaranteed. You have to know how to move out here in these markets, and not just be gambling. Let's see. Management noted continued promotional activity that compressed margins by 330 basis points to 43.3%, disappointing against a 43.7% consensus expectation. And the sneaker giant said it would continue to take a cautious approach in planning our business, leading with international, financial, and operational guardrails. Inventories were also up 16% to 8.9 billion compared with the year ago period, while China continues to remain a sore spot for Nike, with sales declining 8% year over year across the region. Now, kind of a mixed bag across the board when it comes to markets here as of like an hour ago, an hour and a half ago. In Asia, Japan up pretty big, 1.9%, Hong Kong up 1.7, China up 0.3, India up 0.2. The footy in London down 0.1, basically flat. Paris up 0.3, Frankfurt up 0.5, S&P down 0.1, basically flat. Dow flat, NASDAQ down 0.2%, crude oil down 0.4%, gold up 0.3, Bitcoin up 0.3% to 28,205. As always, the two biggest things on the announcement board today are the FOMC, right? FOMC minutes, which is just a transcript of the meeting that they had yesterday. So it's going to announce how much they're, raising interest rates by, if they raise them at all, as well as input from members of the Fed, kind of probably regarding this banking crisis and regarding, their analysis of inflation and their path moving forward, right? So all that will drop at 2 p.m. And then at 2:30, we get Powell. So it's going to be an absolute huge day. You can wait until right before then if you'd like. Um, I might personally, right, just try and get like other work done because I have not been doing too much, in part because of just how crazy markets are, but mostly because of the conference this week has been absolutely, swallowing all of my time. But we'll see what happens at 2 p.m. I'll definitely be tuned in for that. And we'll finish up here with our rapid fire bullet point rundown. So, what else is happening? Sticker shock. UK inflation rate unexpectedly rebounds to 10.4%. Not what you want to see. PIMCO said to lose 340 million from Credit Suisse AT1 debt write-off. GameStop surges after meme player records a record surprise profit. DWAC on watch with Trump expected to be formally indicted today. Vote of confidence ahead of court ruling on SEC XRP USD case. Ford brings an all-electric Explorer to European markets. Dodge, ticker STLA, unveils its last super-fast gasoline muscle car. Intel, ticker INTC, shakes up leadership, announces new foundry leader. And then these stocks are picking up. Bed Bath & Beyond's lost market share. So just a little article to check out there. But that will wrap us up here for the pre-market rundown on Wednesday, March 22nd. Possibly the biggest Fed day of our lives, right? I don't know if I've seen a Fed day with higher stakes than what we are seeing here today. And I'm interested to see what happens, right? But congratulations for you, right, for tuning in here, investing in yourself. You did get 1% better. You can cross that off your checklist for today and worry about continuing to compound that growth as you move forward. It's going to be a very, very, very exciting day, a very, very impactful day. I'm excited to see what ends up happening, but it's most important to just focus on controlling what you can control, right? Remain patient, PAYT, T-I-E-N-T. Remain patient, remain ready, remain nimble, right? Execute when it's time to execute, and you'll be okay, right? But overall, whether you're winning or you're gaining experience, both end up being, the foundation for future successes moving forward. So, everybody, if you got anything valuable from this session, just make sure you show love to this account, right? Go on, like the YouTube Reels, comment on the YouTube Reels, show love to the Instagram Reels and the YouTube Reels. They're shorts on YouTube, right? YouTube, Instagram, TikTok. Go show love. Make sure to check out that content because, again, there's free game being handed out on that content, game that I will likely use when I'm going through and I'm, developing plays myself. So make sure you're abreast on all that, right? Comment one on it if you got something valuable from the info in the reel, right? Because you got 1% better from that reel. But just go out, continue to learn, continue to grow, show love, and I'll continue to show love by being here every morning, letting us know what's going on with these markets. So I'll see you guys, back here tomorrow morning for our next pre-market rundown. Have a good one.